Hi everyone, my name is Justin, and welcome to the first video of my YouTube investment series called Investment Tips and Tricks for Beginners as a part of my personal project. Today, we will talk about key investment terms explained. And in this session, we'll break down essential investment concepts like stocks, bonds, ETFs, and more. For example, understanding how companies like Apple, government bonds, and ETFs like the S&P 500 work will help you guys confidently navigate investments and how to build a balanced portfolio. So, let's dive in. So, firstly, what are stocks? So, stocks represent an ownership in the company. For example, buying one share of Tesla makes you a part owner of the company. So, you can walk into a Tesla dealership and you can say to the clerk, "Hey, I own Tesla," and you're not wrong. So, when you invest in Tesla, how do you get money or how do they grow? So, Tesla's stock price fluctuates based on market conditions, giving you guys, the investors, opportunities for capital appreciation. So, the money you put in will increase in value following the growth of the Tesla stock. And also, another part of stocks are dividend payments. Companies like Coca-Cola pay regular dividends, either monthly, quarterly, or maybe yearly or every 6 months. And dividends provide shareholders with an additional income stream. Next, let's talk about bonds. So, bonds are loans to governments or corporations. For instance, the US Treasury bonds are a popular choice among investors looking for low risk fixed income statements. And bonds also have a specific maturity date when the principal is repaid to the investor. Let's say you buy a treasury bond that expires in 2027. So by 2027, you'll get your capital back, maybe with a little bit of interest. So that means you would make more money. And another instance is a corporate bond, which could be the Apple bonds issuance, where they raise capital for operations while promising to repay the investor with interest. Next, we have another concept called ETFs. So, ETFs offer diversification by basically bundling various securities into one investment. For example, the most popular one you guys might know is the S&P 500 ETF, which tracks the performance of the S&P 500 index, which gives investors exposure to 500 of the largest US companies. It is also cost effective and can be traded throughout the day, like stocks. But unlike stocks, you're holding a bundle of 500 companies, and it gives you a lot of broad market exposure because let's say we have 500 of the best companies. When one goes rotten or one goes bad, another good one comes into the S&P 500. So technically, you're investing in all of the best and most profitable 500 companies in the US, making it a very, very cost effective and diverse purchase. Next, let's talk about how to build a balanced portfolio. So, firstly, assess your goals. What do you guys want to achieve? Determining investment objectives, risk tolerance, and also the time you guys need. So, let's say a young investor might focus on growth stocks like Amazon, while somebody who's already retired might prioritize safer bonds. So, this all depends on you and your own goals. Either you want to set up for the future or you want to make quick money and quick profit right now. Second tip is diversification. So, a mix of assets like technological stocks, for example, Google or Nvidia, bonds such as the US Treasury bond, and ETFs ensure that risks are spread and that you're not any of your purchases aren't volatile to any risks. So, let's say one goes bad, but the other does good. The risk is minimized. But if you're all going into technological stocks without bonds or without ETFs, then if that entire sector goes down, then you guys have lost your money. So it's very important to learn how to diversify and allocate your assets wisely so that you make profit. And finally, monitoring and rebalancing your portfolio. If the tech stocks outperform, you might rebalance by selling some and adding to underperforming sectors like, let's say, Costco or wholesale. So this all depends on your choice and how you want to build your portfolio. Finally, we talk about bullish and bearish markets. So these are dependent on the market. In a bullish market, optimism reigns. So the stock market rally in 2020 after initial COVID-19 lockdowns is a prime example of a bullish market. So it showed investor confidence, but also in contrast, bearish markets like during the 2008 financial crisis reflects declining prices and fear in the market. So if you want to think about it, bull goes up and bear goes down. That's basically a reflection of the market so far. Next, we also talk about buy and sell or bid, risk, ask. So imagine you're buying an Apple stock. The bid price might be $175, which is the highest price someone is willing to pay. The ask price could be $176, which is the lowest price a seller is willing to accept. And the spread of this $1 represents the market's liquidity and also transaction cost. Next, we have our final topic is dividends and IPOs. So as we talked about, dividends are regular cash payments made by a company to its shareholders. So you can take it as dividend stocks are just giving back to the investors or you guys. And next we also have IPOs. So initial public offering, in short IPO, is the first sale of a company's stock to the public. An example of this is Facebook's public debut in 2012. So this IPO or initial public offering was one of the most anticipated in history, raising over $16 billion, and which also marked a major moment in the tech industry. So IPOs is the first sale of the stock, and that determines how the stock grows, how much people like the stock, and how much people want to buy the stock, and that all is reflected on the stock price. Well, guys, that concludes today's session. I hope you guys enjoyed that quick, easy session on how to understand the key terminologies of the stock market. I hope you guys enjoy and stay tuned for the next video. Thank you, everybody.